I'm Austin Kevaney.
And I'm Earl Robinson, and this is our tax research project on the Equine Reform Act of 2015.
The United States horse industry has a surprisingly large impact into the U.S. economy. 4.6 million people are involved in the industry in one way or the other. Directly produced goods and services total to the amount of $38.8 billion in the U.S., and the overall impact of the industry on U.S. gross domestic product is $101.5 billion. Not only does it have a monetary impact, but the U.S. horse industry provides 460,000 full-time equivalent jobs.
In recent years, the supply and demand for the horse racing industry has been on a slight decline. This is partially due to the fact that the chance of losing money in the industry is 90%. With the chance of loss so high, investors are hesitant to invest, knowing that these losses may not be deductible if these losses are considered to be a hobby loss.
If money spent on the acquisition and or training of a horse was eligible for a more enticing deduction, then there would be an increased interest in breeding and buying horses. Currently, many of the expenses put towards racehorse operations are considered by the IRS as hobby loss activities, and therefore can only be deducted against the income from that activity. The IRS uses a list of 9 factors that are used to determine whether the activity is profit motivated or more driven by pleasure. The general rule, as stated in Section 183 of the IRS Code, is if the activity has been able to make a profit in 2 out of the last 7 years, then it is considered to be for profit. Although low chances of making a profit exist, the IRS has the ability to induce spending and revive the industry through a hobby loss revision.
The IRS has the potential to create a change in tax law that would create more jobs while at the same time bluster more expenditures within the horse industry. We would like to propose the Equine Reform Act of 2015, which would be a way to bluster the horse industry, and it would contain 2 provisions. The first provision would be the creation of the equine deduction, and the second would be lowering of income taxes applied to horses classified as capital assets. A taxpayer can qualify for the equine deduction after their horse operation is classified by the IRS to be a hobby loss activity. The one requirement that they must meet is they must have at least 10 full-time employees who are involved with the breeding, training, and or racing of horses. The gains and losses from the equine activities are to be netted, and if there is a loss, it will be multiplied by the deduction rate, which we have created and included in this report as a table.
Starting at 10% for equine losses at the lowest level of the table, the deduction rate is upward sloped to reach the max bracket of $5 million or greater, having a deduction rate of 50%. The equine deduction is limited to the lesser of 2 options: the loss created by the equine activities multiplied by the equine deduction rate, or 25% of the taxpayer's adjusted gross income. The second part of the Equine Reform Act would be to lower the income tax that is applied to horses classified as capital assets. This generates more after-tax income for all investors. While the first provision aims to encourage the growth of current horse operations, this second provision attracts new investors.
An issue with the Equine Reform Act is that it may create incentive for individuals to enter the horse industry exclusively for the loss deduction. This is a valid argument, however, the benefits to the industry outweigh the effect of the tax break. This is evident through the increase in investments and jobs which will be created. The tax benefit directly affects both pre-existing and new equine horse owners, but also indirectly benefits everybody involved in the industry.
Thank you for listening. We hope you enjoyed our tax research project. I'm Austin.
I'm Earl.
And we hope you have a good day.